Welcome back to Morning Trade Live. Let's talk some Apple. Let's talk some tech. Tom White's with me in the studio looking at some options. Adam Coons joins us, Co-Chief Investment Officer at Winthrop Capital Management. Adam, the Apple stock is glowing red right now. We're down ahead of this event. What do you think?
Yeah, I mean, I think this is going to be one of those events that's a little bit of a letdown. The big theme here really of Glowtime is about Apple Intelligence. Their kind of shift with Siri and adding, more generative AI to it. So this is more of a software story for this release. We're obviously going to get a refresh of the iPhone. There's going to be a bigger Max, so that phone's going to be enormous at that point. But outside of some small tweaks to wearables, you're going to get a few different iterations of AirPods and the watch. This is going to be its 10th iteration of the watch. So, maybe a Watch X. I think we'll see maybe some sleek design improvements there. But overall, it's all going to be marginal when you're looking at the hardware side. So the story, once again, really is going to be behind the software, the AI story, and whether that's something that can really push buyers to go and buy this iPhone 16. And I think it's going to be difficult because first off, the phone's not going to have Apple Intelligence right away, and a lot of different parts of the world won't have it for the foreseeable future for regulatory issues.
It's pretty amazing that we're so close, to a fresh Apple launch, a fresh iPhone launch, and we don't have really any information about the main feature, which is AI. And from what I understand, they're not even going to tell us much about that today. That's coming in a couple, later this year, like next month or something.
That's right. Yeah, it is. It's behind schedule from a release standpoint. So yeah, it really, that's why I think this is going to be a little bit of a letdown for investors that are looking for some, big event this go around.
That's where it gets, it seems impossible then to really make estimations on Apple as a stock, on future cash flow and all the basic stuff. It's we don't even know what the product is, but then I hear so many Apple analysts that are so confident they're going to sell a ton of them. Meanwhile, people are dialing back what they spend at Dollar General. It feels like something doesn't add up here, Adam.
I totally agree, because what they do, right, every time they add a new little feature, a new button or something, they increase the price. So I agree. When you're looking at what the consumer behavior shifts are right now, it's hard to see how there's really anything that's going to come out of Apple right now that's going to make people want to rush to the stores to buy a new product.
Tom, hang with us, Adam. Tom, looking at the options. So today we're off a little bit here as the market's up, but Apple's done okay, to be honest, given how expensive the stock was. I thought it was going to be more susceptible to selling, but there were a few moments last week it actually held in there pretty well.
Well, I think people are thinking there's something transformative coming out of this Glowtime event on the AI tool scale.
But they're not. They're not going to get anything today on AI.
They're not going to get as much as they thought they were going to.
They're not going to get anything, but my understanding.
But typically we see that pullback in the shares. We've got some elevated implied volatility going into this. So I looked at a strategy that plays for a move. Maybe it is a good event.
Fade it, Tom.
And the stock explodes to the upside, or maybe it falls pretty sharply. So I constructed a strategy that takes advantage of both scenarios. You just don't want it to sit where it currently is, just below 220. So looked at buying an iron condor, but going out to the September 20th monthly cycle. So giving myself 11 days till expiration, buying this iron condor where I'm going to buy the 212.5 strike put, sell the 207.5 strike put. And then on the call side, I'm going to buy the 227.5 strike call, sell the 232.5 strike call. So $5 wide, need a move type of strategy. You're paying roughly about a $2.10 debit on it. That means your potential profitability, if it goes below 207.5 or above 232.5,
2 weeks.
290
you're
bucks.
Speculating this morning.
Yeah. So,
but
it's not a pure event play because the event's today, right? So you've got 11 days.
I would say it's almost like a market play because I don't even think Glowtime is going to be a big deal.
Right.
I think you're sort of a surrogate S&P trade here, basically, for volatility.
Yeah, it's you need a move. You need some volatility over the next week and a half. But at the same time, if you're the opposite, where you think the stock's going to consolidate, flip-flop this and sell the iron condor. That's the great thing about this type of strategy is I'm buying it, so I'm paying a debit at 210. There's my risk. But if you want to sell it, you can collect 210. But they're both risk defined. I think that's key going into this event. But
you're welcoming them to take the other side of the trade.
Right.
That's how confident you are, Tom, that there's going to be a big move within the next 2 weeks.
If you buy the iron condor, you're confident of a big move.
Right. Okay. All right. Cool. Adam, let's talk later on this week. We got Oracle. Seems like the software trade has been a lot more lackluster than the hardware trade. What do you expect?
Yeah, I mean, I see Oracle as that kind of more defensive play in the software tech and throw in the AI story. They're obviously been the laggard in the cloud move. So, they have fallen behind. They're trying to play catch up. And in some ways, it looks like they've pivoted and they're moving in the right direction. This particular earnings is a seasonable, lull. So I think investors are going to be looking forward. I hope too many investors don't get caught up in this one number because it will be on the lower side. But I think as we look, to next year, because this is our first quarter earnings that are coming up for 2025, it does look like it should be a promising year. They're looking at double-digit revenue growth. That's obviously really coming off of some big wins in the AI space, some big contracts. So I think really as long as we see the forecast and the outlook for management for the rest of the year, maintaining that double-digit growth, I think you'll keep seeing some of that momentum in the stock. And like I said, we see it more as a defensive way to play in the space, especially as we just talked about with Apple. We're starting to see consumer behavior pull back a little bit. I think you want to look at more ways to play defense, but still stay involved.
It's a really good point. I like it a lot because Oracle's chart looks really good technically. Hasn't broken down really at all, hanging out basically where it was last earnings, which is at the highs for the year. And then compared to an Apple, it's like 10 points cheaper forward valuation at like 22. That's not unreasonable by any means at this point, especially if you can get some good growth on the top line.
I was going to say, I think it's one of the reasons why it has hung in there is that, from a valuation standpoint, it is one of the cheaper names. And so I think that once again, that plays into that defensive narrative and strategy that we're playing in Oracle right now.
I like the point of getting to some better growth next year, too. Adam, thanks a lot for the thoughts. Appreciate it. Good stuff.
Thank you.
Nice details there. How do you want to trade Oracle, Tom?
Well, I'm going to look at it from the perspective of what's happened to a lot of tech companies when the bar is high going into earnings, right?
They drop.
If they don't hit perfectly, and even guide perfectly, and maybe margins, they've got high margins for Oracle. They don't hit every metric with the stock just below all-time highs that we saw in July. Hey, maybe this thing falls. So here's a strategy if you believe in that, and you can take advantage of some implied volatility dispersions. The option market's pricing in about a plus or minus 7% move in the shares, just over $10 either way. So I looked at a put diagonal where I'm going to go out to the September 20th monthly cycle, 11 days to expiration, really short-term positioning. Buy the 143 strike put, just slightly in the money or basically at the money. And then against it, in the near term, September 13th options that expire in just 4 days, I'm going to sell the 133 strike put. So $10 wide bearish put diagonal to the downside. You're paying only a debit of about $4.10, so less than half the width of this put diagonal to the downside. Your break even about that 140 level where you can remain profitable on this. But this takes advantage of that, hey, I'm buying an implied volatility level of about 63% on aggregate in the September 20th 143 strike puts, and I'm selling about a 91% in the September 13th weekly 133 strike puts on aggregate.
Okay.
So there's that dispersion, which lowers the price of this put diagonal. But this is definitely setting up for, hey, if you think this thing is going to maybe disappoint, or they're going to beat EPS, they're going to beat revenue, they're going to raise guidance, and the stock still falls, because we've seen that repeatedly in the tech space, and the bar is still high in Oracle.
Fair enough. But, Tom, it's Monday and the market's up, so stop being so negative.
I'm not being negative. I'm just showing you ways to play moves.
No, that's fair. All right. Well, look, catch is it has been getting stuck over and over again, basically above $145. So it's got plenty of resistance. It's going to be a little tricky to get through there, maybe on earnings. when, to your point, there's
Right.
been more fades than rallies on tech earnings the last 2 weeks. Fair point. Thanks, Tom. All right. Thanks, Adam Coons, as well.